Good evening, welcome to the webinar. My name is Roger Royce. I am a partner with the international law firm of Haynes and Boone. I am resident in the Palo Alto office. Theoretically, I'm resident there. We're all sheltering in place still, but I will be resident in the Palo Alto office when we go back to work. So today's webinar is an idea to IPO event. This is all new content. This is a new idea, something new that we're doing, but very much related to the general scheme and theme of idea to IPO, supporting the international startup community. We have a very big crowd joining here tonight. In fact, this might be the biggest idea to IPO crowd that I think I've seen. And yes, this is being recorded. And will be available for playback, and the slides will be available for anyone who wants to bug Rob about it. So a couple of things. This is one of the series. We do a lot of these. This is the first time we've done this in the evening for a long time. Usually they're at lunchtime while we're all sheltered. And the next one will be at lunchtime. It's going to be on June 9 at noon. And that topic is going to be troubled company strategies for startups, because some of us think that a lot of startups are going to be troubled this year, financially troubled. Not all the other usual troubles, not having time for anything else in life. That just goes with even the successful ones. But troubled company terms, what you're going to see from the investors, what you're going to see from your creditors, strategies you can use to protect yourself. That's on June 9, so be sure to tune in. But for today, we have a much happier topic. We're talking about preparing your startup company for venture capital investment. Now, you might think that's an odd topic. Just this last weekend, the Silicon Valley Business Journal, they led with a big headline about how VCs are backing down and are not investing, and they're scared and frightened and not putting money into investments anymore. I don't think that's true. Anecdotally, I haven't seen it that way. What I have seen is the venture capital community just looking for other opportunities, given what's going on. That means telehealth sometimes. That means good telecommunications technology. It means health tech. It means a lot of things that maybe were not as good an opportunity a couple of months ago, now are. It means that valuations are probably going to change. It does not mean that the money stopped. If anything, there probably ought to be more companies getting funded because valuations will go down. Now, we've been comparing for a couple of months what's going on in the markets economically here, let me turn some light on for you, to the Great Recession of 2008. I have to tell you, I was there. I started my law firm, the firm I used to run before I joined Haynes and Boone, in 2006, so I lived right through the 2008 recession. This is nothing like that, especially in the venture community. This one is more of a man-made recession, although we think it's been coming for a while. But in 2008, you saw venture capitalists completely stop. We have a little bit of a pause in the market now. Back then, it was a full stop. Funds would give money back to their limited partners. They just weren't spending it. We don't have that now. What we have is a different set of parameters, different set of ideas, maybe a different set of companies that they're investing in. And that's what we're going to talk a little bit about tonight. All right, I am going to go ahead and share my screen with you. And we will get started. Again, I'm Roger Royce. I'm a partner with the Palo Alto office of the international law firm of Haynes and Boone. All right, let's see if we can get this to work. There we go. First of all, I'm going to talk a lot. I am a lawyer, so I'm going to talk a lot about law, not all about law. This is mixed law and business. But keep in mind, even though I might say some legal things, I'm not your lawyer. I am a lawyer. I'm not your lawyer. Not yet anyway. Come see me later. Maybe we'll change that. Okay, let's start off with some introductory information here about funding your startup generally. Certainly, there's lots of sources of funding. We all know about these different sources. We're going to focus on venture capital for today, but I do want you to know that there is a lot of funding out there. About 10 years ago, I wrote a blog post. It actually, I posted it on somebody else's site. It took me about 3 minutes, just something that occurred to me. I called it Why Venture Capital is the Financing of Last Resort. It actually got the most response of anything I've ever written in my life. some of it quite negative, some of it quite negative from VCs. But my friends, and I have a lot of friends who are VCs, you have to know the enemy, I guess. And a lot of them agreed with me. You know, this is not funding that everybody should take. It's not the only kind of funding. It's a very particular kind of funding for your particular kind of company. We're going to talk about that. So, but just before we get into this, you know, I just want you to take a look. Venture capital is big in startup land. Now, this is a little bit dated. This slide from Fundable is probably 4 years old now, maybe longer, maybe older. But it shows that venture capital is right about the same as angel investors. I think it might be a little bit more right now if you add in the bigger, later stage deals. But what might, and I know crowdfunding for sure is a lot more than just $5 billion. But what's kind of surprising is how much personal money founders put into their companies. Take a look at that. How much friends and family money goes in. But venture capital is nothing to sneeze at. It is a $100 billion a year industry, give or take. About $50 billion of it sits right down here in Silicon Valley where I live and practice. So it's still sizable. There's still a lot of money out there. Of course, most founders, like I say, they start on their companies on their personal savings, which everybody is going to have to do. They're going to have to get a little bit of skin in the game. But at the end of the day, the game here is other people's money. You want to be using other people's money for your idea. And the reason why is because if you're a typical venture-ready startup company, you're in an extremely risky business. The rewards are tremendously high. I'll talk about that in a minute, but the risk is very high. Don't risk too much of your own money on this, just enough to let people know you're serious and committed to this. There's also bank debt. They're going to want security. They're going to want personal guarantees. But that is another source of funding for startups. There's money from the government. There's a lot of it right now that you've probably heard about. We did a whole panel on this about a month ago on the Paycheck Protection Program, as well as the EIDL, the Economic Income Disaster Loans. Check out Rob's videos on the Idea to IPO YouTube or website, and you can see what money is available for government during these times. I do want to say that the SBA just came out today. Almost every day they come out with new announcements. There's going to be an automatic audit of every paycheck protection loan of $2 million, and they're very clear over and over again. You know, you only get this money if you need this money. So keep that in mind. It might not be as freely available as you might think. It seemed everybody thought this was free money the government was giving away. Yeah, not quite. I'd be careful about that. But back to traditional startups. So most startups are going to raise money from their friends and family. It's not going to be very much, just enough money to get them going. Just enough to, and friends and family, think of it as people who are going to give you money on faith. They're going to give you money without seeing proof of concept, that will give you money without seeing that you have revenue or traction. That's your friends and family. The next step up, of course, is going to be angels, angel groups, and angel funds. And there was a time when these people funded companies with nothing but a PowerPoint. These days, especially in my neighborhood, even the angels are going to want to see traction. They're going to want to know that whatever it is that you're making, you're going to be able to sell. We're not talking about those today. Today, we're going to talk about venture capital. Okay, we're going to talk about the big money, the first institutional money that goes into your company. Alrighty, again, I want to give you a few more stats before we get into the meat of things. Well, we let more people join. So here are some numbers from Crunchbase, and there are 1 million of these studies out now. They all came out in Q1 of 2020. I like Crunchbase best. That gives you an idea of what the dollar volume of venture capital is and how it's divided. Notice how early stage and late stage divide up that money. Quite a bit of it, and small amount of venture goes. Why do you suppose venture goes into angel and seed at all? We're going to talk about that before the hour is over. Keep in mind, some of it is available. You might not expect a big fund to want to put a couple $100,000 in your company, but they might do that. A little bit of money does go there just to secure their place in line for your real institutional round. Projected early stage investment, I'm guessing that most of you in the audience are very early stage. This is what you can expect. It's a little bit down from 19, but these are still pretty respectable numbers as of Q1. No doubt we will have a drop in Q2. All the deals that I was working on, as long as we were in play, as of the end of March. We stayed in play and we finished those deals. I will tell you anecdotally, the ones that we had not gotten that term sheet signed yet, those ones paused. Most of them did. But they'll come back, don't worry, just at different valuations. But you can see the numbers for Q1 20, not what they were in Q4 of 19, but still respectable, still big numbers. Technology growth investment through Q1, still pretty high, a lot of capital invested. It's down from last year, it's down from last quarter, but these still $2 billion is big numbers. It's nothing like it was in Q1 of 19, of course. Late stage investment, oddly enough, a little higher than Q1 of 19. I guess that tells you that the early stage went down year over year, but the late stage went up. Round size, we don't have to spend a lot of time on this. I don't think I have a lot of late stage investors here. And early stage round size. All right, here's some, so again, numbers have gone down, but the median has gone up. By the way, if you have questions, there is a Q&A dialog box either at the bottom of your screen or the top of your screen. Don't use the chat feature. Use the chat feature if you want me to talk louder or something like that, but don't use the chat feature to ask me a substantive question. Ask that in the Q&A box. We're going to gather all those, and then at 8 o'clock at the top of the hour, I'm going to open this up to questions. I'm going to take those questions. All right. Worldwide, US and Canada, rest of the world. Obviously, most of that money gets invested here in the US and most of it right here in Silicon Valley. Okay. Oh, well, let's move on. So let's get back to my first question. Are you a candidate for venture capital? Should you take venture capital? Do you want to take venture capital? Do you think that's really a smart idea? So I want to go through all the reasons why you shouldn't take it. And then we're going to talk about why you will and when you will and what that will be like. But first of all, and this sounds obvious, but I want you to think about this for a minute. To take venture capital, you are going to give up equity 100% of the time. It might be debt that converts into equity, but it is going to be equity. VCs do not want debt. They do not want debt return. They don't want debt risk even. Remember, venture capital is high risk and high return. I'm going to tell you why that is in a minute, but just keep in mind you're going to give up equity. Why am I pausing on that for so long? Well, I'll tell you why, because equities, when you sell equity, that is the most expensive money you can take. It is the most expensive money you can take if you're successful. Obviously, it's the cheapest if you fail, but nobody starts out to fail. Nobody plans to fail. So you're planning on being successful. If you're giving up equity, that's going to cost you a lot more in the long run than debt. But a typical venture capital, then why would any company do it if it costs so much? Well, I'll tell you why. It's because you're probably not a candidate for other types of financing. What other types of financing are there that we talked about? Well, obviously debt, right? Debt is the most obvious. That's what companies, in fact, on the chart I showed you, the first slide showed that debt financing was far greater than venture financing for businesses in the United States. But in order to be a candidate for debt financing, you got to be able to pay interest, and you got to be able to pay the principal back at some point. And you got to be pretty darn sure you can, and that you've got good fundamentals, or be willing to put up security or a personal guarantee behind it. All right. So in order to do that, your lender is going to want to see cash flow. In fact, after Dodd-Frank, if it's a commercial lender, they're going to have to see income and cash flow. So if you have near-term cash flow, think about debt. You can think about venture debt if you want to, do something that's a little riskier. But think about debt. Okay. If you don't have near-term cash flow, you might be a candidate for venture capital. It's very risky. It's illiquid. And that's the other thing about venture capital, right? And a venture capital investment in your company is going to be there for a good long time, much longer than it used to be. I'm going to talk about that in a minute, but a VC investment in your company is going to be there for a while. Now, if you're the venture capitalist, you're thinking about that. You're thinking about how long you have to stay in the deal. But why should you as a company care so much about that? And I'll tell you why. And it goes back to point number one, giving up equity. When somebody's a debt holder in your company, you can buy them out. You can get rid of them. You can find someone else to replace them. you can take them out. All you need is another investor, a debt or equity investor. If somebody owns stock in your company, you're married to that person. Okay, you're worse than married. You're stuck with them to the bitter end. Unless both of you agree that that they're going to get cashed out and you have the money to take them out. So you're going to be long-term partners. So when I say the stock is illiquid, I mean it's going to be a long time on average before you exit, much longer than it used to be, much longer than it was when I started doing this 20 years ago. It's going to be probably twice as long than it was even 15 years ago. So you're going to be married to that person for a long time. It's illiquid both from the investor standpoint, but also from you, the company standpoint. Okay, some other factors. So venture capitalists, I'm going to give you some economics in a minute, but the first question they're looking at when they look at your company, they want to know if you can scale. If you've got a good lifestyle company that earns, current income and can throw off a little bit of return, but is going to be worth maybe $10 million some way and exit, you are not a candidate for venture capital. It's just not enough to move the needle for them. They need something that has explosive growth and a humongous market. Okay, they want something that could potentially give them 100 times return. Sounds crazy, doesn't it? But think about Facebook. Think about the returns that the investors in Facebook got. Think about Snapchat. Think about some of the big companies that have done really well that started with venture capital. They look for those sorts of home runs. So they need explosive growth, and they need a business that can scale. And they need a huge market. Now, that doesn't mean it has to be a market that you can see today. That helps, but a lot of times it's a market that people can envision. I mean, let's use Facebook as an example. Before there was a Facebook, I don't think I could have foresaw that there was that kind of market. Before sheltering, I don't think I could have foresaw that Zoom would have the kind of market that it does. So at least has to be a market that you can envision. And I think the big companies of the future, as has been the big companies of the past, the big success stories that are venture backed, have been industries that didn't even exist 20 years ago. There are new industries, but you have to be able to show that there is going to be that big market, even if it doesn't exist today. Why is that? So let's do some venture capital economics 101. Know your enemy. So here's what they're working against, the investor. First of all, most funds use this 220 formula, meaning that their investors, the venture fund itself, is going to be organized as a limited partnership, usually, sometimes an LLC. I do some fund formation work. I go both ways on this, and foreign or domestic, but almost always it's going to be a 2% management fee. Sometimes it's 2.5% and it scales down over time, but let's just say 2% management fee. What that means is that every year, this venture capital fund, this pool of money from limited partners who are tax exempts, they're foreigners, they're pension funds, they're rich farmers out in Fresno, they're high net worth individuals, whatever, East Coast family offices. This pool of money from all these investors is going to pay the managers or the general partner 2% of the committed capital. That means the amount that they promised to invest every year. And the general partner is going to use that money to cover their expenses, their rent, their staff, their overhead. On top of that, and this is typical, but you see variations in the formula a little bit. Sometimes it scales and moves around. On top of that, there'll be what they call a 20% carried interest. And by carried interest, what we generally mean is the gain, the profit. So the investor takes the money in the pool of money, the VC takes the money in this pool, they invest it in the company eventually will exit, which means a sale, or an IPO, whatever it turns into cash, and we split up the profits. We give back the investment to the limited partners, and we split the profits 20-80, 20 to the VC, 80% to the investor. Now, here's an interesting fun fact. Why do they call it carried interest? If anybody knows, put it in the Q&A, and I'll get to it at the end. Because it's kind of an odd word for what is really just profit, right? But I remember the first time I heard it, it made no sense at all. But so put a pin in that. Let's see who can answer that bit of trivia. All right, venture capital economics. Limited partners typically are looking, the VC's limited partners, they're looking for 3 times their return. They got a real appetite for risk as well. And some of them have done spectacularly well, especially some of the university endowments, because they know how to pick a fund. Okay. Okay, so just think about that. If you do the math, in order to return to limited partners the kind of return that they're hoping for, and the VC is promising them, that fund is going to have to, earn 3 or 4 times its money. Okay, put a pin in that for a minute. 3 or 4 times its money. So far, that doesn't sound so bad, does it? Right? Maybe your $10 to $50 million company that you think you'll exit at can get that kind of return. You're not asking for that much, right? Well, until you consider we're investing in very risky investments, and half of those are going to lose money. That's just what we expect. We expect half of them to lose money or maybe break even. 20 to 30%, they'll return their money. Maybe they'll double their money. Okay, well, that's cool. But the rest, in order to hit those numbers, have to be home runs. There's going to have to be some home runs in a portfolio. So all of you should pick up the book, Secrets of Sand Hill Road. You can read Scott Kapur's analysis of this, and he uses a great example. He says, suppose you have a fund, it's X size, it doesn't really matter. It makes 9 investments. They all fail or they come back even, but your last investment turns out to be, it turns out to be Facebook, or it turns out to be something that returns 100 times your money. How much money did you have to make on the first 9? And his answer is, it doesn't matter. It doesn't matter, because venture funds are waiting for that one, home run, and they're hoping you're going to be the home run. So keep that in mind. Those are venture fund economics. And that's why, to be a good fit for venture, you're looking at a huge potential market, maybe a first mover or a first go to market advantage. You're looking not for short-term profits. VCs hate that. Sounds odd. I sat in enough board meetings, where they say, look, we don't want any income. We don't want to pay any tax. We want to build the long-term value, not the short-term income. And definitely they all want to see traction. They're going to invest in your company. And traction, you hear that all the time. A lot of times people say it means income. It means that you've shown that the company can make money. I think it's, or revenue, I should say. I think more than that is you've shown that people are going to buy your product or pay for your service. Because if you can sell 1, then maybe you can sell 10. If you can sell 10, then maybe you can sell 1 million. All right, a couple things on venture capital economics that I want to leave you with before we move on to some of the terms. Is that you need to understand about management. Now, venture capital is different than private equity. It's different than hedge funds. It's different than other types of investors. And the way that it's different is that your VC is going to participate with you in management. That is the nature of a venture capital strategy. Okay. In fact, under the Investment Advisors Act, it's sort of required. We're not going to get into the regulatory issues, but you're going to see the VC has to have control rights for various reasons. So they're going to participate in management. How's the investor going to do that? Well, it's going to take a board seat, maybe more than one. It's going to have board observers. It's going to have rights in a side letter to participate in management. So just expect that you're bringing on a partner when you take venture money, and they're going to be there with you looking over your shoulder. It's not a passive investor. So that's the other thing you need to think about. Now, think about that from the VC standpoint. If they actually have to manage their investments, there's only so many boards a person can sit on. Maybe 5 boards a partner can sit on, because they got to prepare. They got to go to board meetings. They have to actually work at this. So that limits the amount of companies an investor, a VC, can invest in. So they really do have to pick winners, right? And they have to make bigger and bigger investments to justify the growing size of the funds, although they've been getting smaller lately for good reason. So just keep that in mind, that, management. They're going to be managers, and that's going to limit their bandwidth, limit the amount of companies they'll invest in, and probably increase the size of the investment. Secondly, think of a term of a venture capital fund as being 7 to 10 years, maybe a little longer. When I form VC funds, I usually do 7 years plus 2 or 3 one-year extensions. I know the bigger funds go a little longer than that. But just think of that. That's important to know that how long the term is, because when you're talking to a VC, you kind of want to know where they are in their life. If they're getting towards the end of their term, you would expect them to want you to come to an exit fairly soon. If they're at the beginning, if they're in year one of their term, they're probably not going to push you as hard to exit when you might not want to. And I can tell a lot of horror stories about that. I can tell you about companies that took on investment and lasted exactly 7 years and sold when at the very low point of the market, because that's when the VC had to exit. That does happen. So it's a good question to ask in diligence. You know, how old is your fund? How much time how much dry powder do you have? How much additional follow-on investment? How much longer? Okay, preclude small investments. We talked about that. Now, when the VC comes up, again, are you a good candidate for VC? All right, so big market, all the stuff we talked about. But now let's look at kind of at a micro level at the company itself. When they look at you, keep in mind, they can only make so many investments. And as much as you think you have no competitors, I think you probably do. And there's probably somebody else out there doing what you're doing, right? Or something very similar. So how are they going to pick you over somebody else? Well, the number one factor is going to be team. Technology is nice, but I've seen this over and over again, companies with inferior technology winning the venture capital investment. I see it over and over again. I mean, I see a lot of companies, tons of them, hundreds of them, maybe thousands. I'm surprised oftentimes when the best technology doesn't win. Something else does. And the question for you is, what is that something else? Well, number one is going to be team. You know, they want to know that they're betting on this team over the other team. They're also betting that the team that they're investing in is better than any other team that they could invest in that particular business. So keep that in mind. Team is really important. Keep that in mind when you choose your co-founders. Make sure you've got somebody with domain expertise. Make sure you got somebody who's technical. And most of all, make sure you have awesome people on your team. Technology, you're going to solve a problem. You're going to address a pain point. You know, it's got to be an aspirin, not a vitamin. It's something that people need, not that's just nice to have. You hear that a lot. I think that's going to be even more important in 2020, where we're, you know, just almost every meeting I sit in now, it's a matter of need. It's a matter of what's essential. What do we have to have? Not so much a matter of what's nice to have these days. And then market size, we talked about a huge market. I see your questions coming in. Just keep collecting them. We're going to get to them at the end. Put them in the Q&A box, not in the chat box. Now let's get back to you. That makes you a good candidate. Let's suppose you are a good candidate. You got a huge market. You've got an awesome team. You're solving a real problem that's causing pain for somebody. You're capable of scaling this thing. You've got good technology. You're going to be the first to market. That's why you need the money. You want to get into the market before anybody else does. Suppose you're in the enviable position where you're picking the VC, right? You're the prettiest girl at the ball, and now you're picking the suitor for the next dance. Well, how do you pick a good VC? Number one, reputation. Reputation. Number one, reputation. You're going to be married to these people for a long time. It's going to be 10 years probably. By the way, many years ago, when I started doing venture stuff, everybody was going to go public next year. You know, no matter who they were, when you ask them, you know, when's your exit? Next year. You know, that didn't happen all the time, as you might imagine, but everybody thought they could. But what did happen is they got to IPO fairly soon, like 4 or 5 years. That doesn't happen anymore. It takes a long time for a company to go public, if at all. And I rarely see that. I see exits as being sales of the company. So you're going to be stuck with this VC for a long time. So check out their reputation. Talk to other founders. I will tell you that VCs have reputations in this valley. If you talk to people, you'll find out who you're dealing with. And here's something I'm going to give you a tip. You're not going to hear this anyplace else. I've learned this only through hard-won experience. Go online, go into the court websites, find out who's litigious. Okay? A lot of people are going to hate me for saying this, but find out who's litigious. You know, who has sued people when things didn't go their way. Because odds are this is not going to go everybody's way. Odds are against you. If it does, the rewards are huge, but odds are you're probably not on your first time out, maybe not on your second or third time out. So prepare for the worst. Find out who's litigious and do not do business with those people. I'm telling you that right now. Some people they're grown-ups, they take their lumps, they move on, they go on to the next thing. Nice try. Other people come back and will sue. Personally, I do a sort of background check on everybody I do business with, even clients. I won't take on a client that's over litigious. Life's too short. I don't want to spend my life with people like that, and you should not either. So check out reputations, but check out their online reputation as well. It's so easy now. You can go online and find out so much about somebody. And God, there's nothing worse than a litigious VC. There's nothing worse than an investor that might want to sue you, because I got to tell you, the rule when you sell securities is seller beware. You know, no matter how careful you are, how good you are, you got vulnerability all over the place if somebody's unhappy. Number two, likelihood of closing. You might find out how often do these guys actually close. Are they signing this term sheet with me just to tie me up while they shop and find another deal that might be as good? Or are they actually going to close? Again, there's reputations here in Silicon Valley. You'll know who closes. There are VCs out there that you can take it to the bank as soon as they sign that term sheet. You know you're closing without any games, without any BS, nothing sneaky, just straightforward. They signed it, they mean it, they mean business. Make sure you're dealing with one of those people. Stage of the fund, we talked about this, are they towards the end of their life or the beginning of their life? It's going to have a big say in how long you're in business. Trust me, because the VC is going to have protections that are going to make it, that are going to give them the ability to encourage you to exit. It might be before you want to. Size of the fund will give you an idea of, for the next one, how much cash do they have to do follow-on investments. This is important. You know, very few companies take one round and exit. You take one round so you get to the next round, right? So is your investor going to be there for you at the next round? Because if they're not, that is a very bad signal to send to the market, right? You don't want to tell the market that your early investor won't even put more money into you. They're willing to gamble on losing what they've already got. And if they're not able to because they don't have any money left in their fund, well, you might want to know that little fact going into this, because it's going to be very difficult in the market to go out if your existing investors don't believe in you or are perceived as not believing in you because they can't do any follow-on. Similar, is there a fund 2? Is there a fund 3? What a lot of these guys will do is they'll form fund 2 to prop up fund 1. No one's going to say that, all right? In fact, I feel bad that I already said it, but that's what'll happen. Fund 2 will do follow-on investments in fund 1. And that's how they get around this problem. There's nothing wrong with that as long as it's a good company and they got good metrics and it turns out being a good deal for everybody. And I think we talked about the litigious side, probably too much. Okay, let's get into a little bit more nuts and bolts. Business model, I'll let the business people talk to you more about that. I'm just going to say a few things in a minute. But first, choice of entity, I do a whole hour on this, an entire hour on choice of entity, but it's about 20 seconds worth when it comes to VC financing. You're going to be a Delaware C corporation, okay, a Delaware C corporation. You might start life as an S corp or as a limited liability company or even a Cayman corporation. You're going to end up as a Delaware C corporation when you do your venture investment. The reason why is because that's what VCs want to invest in. And I'll just pause on this for a minute, just so you know. I mean, it's I guess you don't have to know how the sausage is made, but you might want to know a little bit about the sausage. The reason they'll only do that is first, their organizational documents likely prohibit the venture capital from investing in a tax pass-through entity like a limited liability company. Means you got to convert your LLC into a corporation before you close or at close. Why is that? Because the VC's limited partners are tax exempts like pension funds or they're foreigners. And tax exempts of UBTI, unrelated business taxable income, it's a bad thing as a tax matter. The limited partners, if they invest in a pass-through, and the foreigners have effectively connected income. ECI, another bad thing as a tax matter. So their organizational documents are going to require it be a corporation. Okay, so far you're with me, but why not a Wyoming corporation, right? I mean, they have good crypto regulations. Why has it got to be Delaware? That is the gold standard, Delaware. It's internationally recognized. Everybody knows Delaware. Everybody understands it. The VCs love it because Delaware has very clear laws. The judges will enforce the laws as written, unlike some other states, which will, remain unmentioned here, and California. And thirdly, Delaware allows you to abrogate class voting. So in other words, you don't have to have a big vote of all of the preferred stock investors together. Each one can have a separate class voting, or I'm sorry, all of them can vote together. You don't have to give each one of them a separate vote. And that'll be important. I'm going to talk more about that in a little bit because it'll give you a little bit of an insight as to some of the dynamics when you get into these later rounds. But you're going to be in Delaware, so you can have that flexibility. Cap tables. Hopefully I got a lot of slides on this. I have a lot to say about cap tables. You really need to spend time on your cap table. You really need to do the what ifs. Here I am now. This is where I want to be after my third round. This is where I want to be after my second round to get there. This is where I'll be after the first round. This is what my ownership's going to be. This is how much stock I'll have left. You should be strategizing to the nth degree with a cap table. You should all be very good with Excel, just doing what ifs, although some of the online cap table tools will do that for you. But you definitely want to plan. The best entrepreneurs, the most successful ones, are the ones that sat down with me and we just planned it out. These are the what ifs. This is what might happen, what might happen. If this happens, then that'll happen to me, that kind of thing. And what is the thing that might happen to them if they lose control of their cap table? Well, number one, it might be so screwed up that there's no common stock left to incentivize management, in which case you will not attract any follow-on capital. Or number two, you might lose control too early, in which case we play that game here called Fire the Founder. I'm going to get to that in a minute. Vesting. You definitely, every venture capital-backed company is going to have vesting restrictions. Do you all know what vesting means? I didn't think so. Vesting means that you earn into your shares through continued service. So that, let's say you have 4-year vesting on your shares. That means if you work for the company for 2 years and you leave the company for whatever reason, you keep two years worth of the shares, half the shares, and you give the other half back. That's vesting. Every VC is going to insist on that. Put it in place early, by the way, and that way you don't have to negotiate with your co-founders as much when they get there. By the way, you know, there's this cruel joke called 4-year vesting in Silicon Valley and everywhere for that matter, or 3-year vesting, or maybe even 5-year vesting. You don't feel too bad as a founder because you've got 4-year vesting. I'll tell you something, you're going to have to reset that vesting when the new investors come in, because you might be almost full, you might be half vested in your stock by the time you take your venture capital funding. Do you think the VC is going to let you get away with only sticking around another 2 years? No, you're going to have to unvest those shares and extend for another 4 or something like that, something to keep you around long enough for the next valuation point. And debt. I just want to warn you, debt is a bad thing on your balance sheet. Debt comes at the top of the preference stack. That means when a company gets sold or it exits, the debt gets paid before the venture capitalist does. That's bad. VCs don't like that. They don't like money in front of them. So if you have debt on your balance sheet, it's not the end of the world. If it's convertible debt, it's okay because you'll turn it into equity, which moves down the preference stack. But if it's just straight debt, it's a negative thing. And by the way, royalty financing is viewed as debt oftentimes. Just keep that in mind. You know, I want to mention a couple. I'm going to have to move fast here. I'm not even halfway through my slides and we're almost out of time. I'm so embarrassed. Sorry, Rob. Let's talk about this. I use this slide a lot. Well, again, this goes back to what kind of company is ready for VC. As you're figuring out your business model, I've had companies come into my office and say, you know, we got such a great technology, we're just going to license it. We're going to license to everybody in the world, and we're going to make a lot of money, and we're not going to have to put a lot of money in capital and equipment. What a great idea. And it is. That's the yellow line on my slide. It's not a venture capital idea, though. That yellow line just can't go high enough because somebody else is picking up the product revenue. You're just picking up the IP portion of the revenue. A manufacturing play, on the other hand, that can pick up the big money. I've got plenty of anecdotes about it. I've told them enough times, I don't have to do it here, but you want to be a company that has, see where my arrow, whoa, sorry, I've had the chat box open this whole time. See where my arrow is? You want to be a company that's going to have the big investment here on the front end, and then have the big return way up here at the manufacturing end. You don't want to have the little investment up front and the little return. Okay, we talked about choice of entity. I'm going to pause on one more thing about choice of entity, because everybody ought to know this stuff and they ought to be walking around knowing this. One of the big advantages of corporations now, using corporations, is that we have this thing called qualified small business stock, and it's been around long enough now that almost every investment that's, in other words, investments that were made more than 5 years ago qualify for this exemption from tax. There's a 5-year holding period. So if you're an investor, and it can be a fund that has individual LPs, makes an investment in a qualified small business, it gets this stock, it holds that stock for more than 5 years, it can sell that stock absolutely free of federal income tax up to $10 million or 10 times their cost of the stock. That's a huge benefit. That's a huge benefit. It's a huge giveaway. Probably won't be there forever, but this had bipartisan support. So that's huge. That's another reason you want a Delaware C corporation, so people get qualified small business stock treatment. You don't get that with an LLC. You don't get that with an S corporation. Although I've got a few tricks up my sleeve to get you that benefit if you've made a mistake and you form that way. Okay, we've talked about VC considerations. We talked a little bit about vesting. I'm going to move this a little more quickly now. It's wise for your company to have advisors when you go to the venture capital community. I think that's a great idea. I think you want to have advisors. I think anybody who can add value to their company for a small piece of stock, and your advisors are going to take a little bit of equity, usually in an option, sometimes in stock. It's going to vest, usually over 2 years. It'll be between between 0.1% and 2%. Standard I start with is at 1/4 of 1%. It goes up or down from there, depending on how important the advisor is and how far along you are. And we also want to put milestones in that vesting. We'll typically do options. Sometimes we'll do restricted stock. By the way, you can forget you ever heard the word RSU. I know everybody heard about the big companies' RSUs. You're not a candidate for those. They are tax disadvantageous for most privately held companies unless you're really close to a liquidity event. Who should vest? Everybody. How long? If you've heard my other presentations on startup basics, you already know this. Founders vest over 3 years, sometimes 4. Advisors vest over 2 years, typically. The rank and file optionees, usually 5 years. They will accelerate. In other words, they get full vesting only for like your select group of founders if they can negotiate accelerated vesting. This is a very kind of hot emotional topic with VCs. So keep in mind, you may have this discussion and you may ask for acceleration. You're never going to get it on change of control. What that means is when you sell the company, all of your shares vest, all right? Because it seems fair. I got you to a sale. I shouldn't have to stick around for 3 years after the sale to get the benefit of my ownership. You never get that. Other times, founders will say, look, I want full vesting if I get terminated without cause. Because it's not my fault. It's not like I quit. You fired me. You shouldn't be able to take back my shares if you fire me. That single trigger termination without cause vesting, you don't get that either. What you sometimes get, if you negotiate for it and if is a double trigger, meaning that if both those things happen, sale of the company that makes you redundant. Let's say you're the CFO, right? And your acquirer doesn't need another CFO. They're a dime a dozen. I don't know if they are or not, but let's say they think it that way. So they terminate you without cause as a result of the change of control within a short time. Then you should get full vesting. All right, you can get that sometimes if you know enough to negotiate it for it. Don't give that to everyone in your company. It's very expensive. It costs you. By the way, everything you as a founder give up on vesting is going to cost you on exit, because the acquirer then needs to figure out a way to incentivize and retain your good people. And that's going to come out of your hide, nobody else's. We talked about this. One thing I want to mention that I'm seeing is this unfortunate trend to extend option exercise periods. So a little bit of a primer on options. So stock option, rather than granting or selling stock to your employees and consultants, because then they got to come out of pocket, right? They got to pay for the stock. That's a drag, or they got to pay tax on the value of the stock. That's a bummer. We can use the stock option plan. And under stock option plan, that individual is given a right to buy stock at this price. That price has to be the fair market value of the stock on a date of grant. So if the stock's worth a dime, on a date it's granted, I have a right to buy stock for a dime, and I can exercise that right down the road when the stock is worth $1. So I make 90 cents. It didn't cost me anything. What a great deal. I made 90 cents. I didn't have to come out of pocket. And if the stock goes bust, I didn't lose anything because I didn't have to pay for it. That's an option. ISOs have to be exercised within 90 days of termination of employment. And that's a special class of stock option that provides tax benefits. There's no tax on exercise, and there's capital gains when you sell the stock, provided you hold the stock for a year, 2 years from date of grant of the option, 1 year from exercise. But there's alternative minimum tax on top of that. Don't get me started. They're not worth it. That's my advice. So most of my companies do NSOs, non-statutory options. You don't have to exercise within 90 days. It's whatever's in your documents, whatever the board has the authority to grant. So we're seeing people say, look, you're leaving the company. We don't want you to exercise. We don't really want you on the cap table. We want to reward you. You want to keep some skin in this game. You don't want to come out of pocket for the exercise price, but you want to keep some of the upside. We're just going to have an extended exercise period. So instead of 90 days to exercise or 30 days, we're going to give you a year. We're going to give you 2 years, maybe 5 years. It's a trend. I see that more and more now. I don't like it because I think it messes up the cap table. I think it gives you too much option overhang, and it's hard to know. I've seen companies, have ridiculous results with this, where it was hard to tell what their fully diluted capitalization really was, because there's so many options out there. I mean, with the typical option plan, we kind of get an idea of where you're going to end up with that plan. But with these long exercise periods, you can't assume that options are going to be canceled in return to the plan. So I think it's dilutive, and it makes it changes the economics and the planning. A couple other things I want you to know about. Class F super voting stock. Facebook did this, Google did this, Snap did this. And this is the idea. I see this popping up more and more and more now, and the VCs are starting to even get okay with it. This is the idea that the founder says, well, look, as I get diluted here, I'm going to have a little more than 50, I'm going to have probably less than 50% of this company after I do my venture financing. And, I want to be able to control the common. That's what it is. I'm the founder. I had to give stock. My lawyer said I had to give stock to all of my service providers because I didn't have any cash. So now I got all these people with voting rights, but I'm the founder and I should have the say. I should have control of the common stock. So how about we give me some Class F stock, and my Class F has 10 votes for every share instead of 1 vote for every share, like all my minions who are around me with their shares of common. Very common. We're seeing this. Just plan on having it negotiated away unless you're Facebook or Google or Snap. I try to talk people out of it because I don't think it's going to last very long. Sometimes I'm successful, sometimes not. I've seen it work out well. I've mostly seen it just go away. Be aware that it's out there. It is a tool in the toolkit. Want to talk about transfer restrictions. Once you, and these are mostly VC terms, but I'm seeing this pop up pre-financing now more and more, where companies will just put in place all these restrictions on shares even before they get to the venture capitalist. What are transfer restrictions? So here's the concept. Someone has shares in your stock. You're okay with, them having shares. You're not okay with anybody else having their shares, especially a competitor. So your inclination is, oh, I know, we'll just make this shares non-transferable. Well, there's some real questions as to whether that's enforceable or not, especially here in California, where we don't really have laws, we have courts. So instead of that, what we might do is make it really hard to transfer those shares rather than saying you just can't do it. So how do we make it really unattractive? Well, a right of first refusal. So you will rarely see a share of stock, common stock, preferred's a different story. A share of common stock in this valley issued without a ROFR, a right of first refusal. It means the company has a right to buy the shares back before you can sell it to anybody else, usually at the offered price. And that's a ROFR. What you'll also see on your common stock is a lockup. That means if the company goes public, you're locked up. You can't dump your shares into the market for a period of time after the company goes public, usually 6 months. You'll see that in every common stock purchase agreement. Co-sale rights. What does that mean? That means that if you sell your shares, then the person with the co-sale right has the right to participate in that sale. Drag along is just the flip side of that. It means if you have some shares that you want to sell, but your buyer wants everybody's shares, or wants 90% or whatever it is, you have a right to force other shareholders to participate in that sale. That's a drag along. So think of a co-sale or a tag along and a drag along. Flip side. Buy-sell provisions, rarely see in a startup environment. Don't bother with it. Closely held, yes. Startup, so a buy-sell means if somebody leaves, the company can buy back not only their unvested shares, but their vested shares at fair market value. The reason you don't see them in a startup environment is because that value is probably going to be pretty darn low, unlike your typical closely held company. Until you're out there closer to exit, until you've done a finance, and you probably don't have a lot of value in your shares. It's not nothing, it's not 0.0001 where you incorporate it at, but it's low enough where we don't worry about it. And Rule 144 is a securities related exemption. It keeps you from reselling shares that you've got for a period of time, depending whether you're an insider or not. But plan on having to hold your stock for a year after you get it before you can sell it. A couple of other terms before we get into some VC terms. Safes and convertible notes. I need to talk about this. Remember what I said in that financing lifetime. You're going to start off with your own money. You're going to get some friends and family money. You're going to get some angel money before you even ever see a VC. Well, how are you going to take that money? What are you going to give the investor in exchange for that? It used to be convertible notes. That's a debt obligation that just converts into preferred stock down the road. Most often these days, it's a SAFE, Simplified Agreement for Future Equity. Think of it as convertible equity. Now, I want to tell you two things about this and warn you off of a mistake I see made over and over and over and over again. So the two things you need to know. So the SAFE is, think of Wimpy and Popeye. I'll gladly repay you on Tuesday if you buy me a hamburger today. All right, you give me the money today, and I'll gladly give you preferred stock when I do a financing down the road. And because you got in early, I'm going to give it to you at a discount. So for every dollar you give me today, I'll give you $1.20 worth of preferred stock down the road. That's a discount. Every one of these has that, almost every one. Okay, that's cool. I get that. We get a discount. We saw the future. We got in early. As safe holders, that makes sense. Number two, and this is the tricky one, valuation cap. Because every lawyer has made this mistake once in a career, where you don't have a valuation cap when you represent the investor, and the startup company takes the investor's money and builds a hugely valuable asset. And now the SAFE or the convertible note converts into stock in that company at a huge valuation. And the investor says, wait a minute, if I'd have bought preferred stock or done a price draw when I put the money in, I'd have like way more shares than I have now. How do I protect myself from this runaway valuation? And we could go on forever about the wisdom and why valuation caps are good. I listen to professional investors just be philosophic about it, but I won't do that. I'll just tell you that typically what we'll do to protect against that is say that the early investor's money is going to convert at a maximum valuation. So your money is going to get some minimum percentage of this company. Here's the rub. You need to pay attention to that. Most valuation caps that I see are way too low for the amount of money being raised. And people don't realize it because, especially if you have a pre-money valuation SAFE, you're not going to know how much stock your early investor is going to have until you actually get to the financing. You'll have some idea, but you won't know for sure because it depends on future issuances, future SAFEs, future convertibles. The big variable is the stock option plan plus the future money. So be careful, because then you get to that event and you do the numbers and you finally sit down and look at that spreadsheet I told you to keep early on, and you run some what ifs and like, holy cow, look at how much the company, the safe holders got. I shouldn't have let him get in at that $4 million pre-money valuation. It should have been a lot higher. It should have been 12 million, or more accurately, I should not have sold so many safes. That's the one complaint I hear most often. I shouldn't have taken so much money in the early rounds with these simple instruments. I went online and I Googled it and I did it myself. I didn't have to pay those lawyers to do any of this. I didn't really understand what we were signing, but my buddies who own startups did it. It's good enough for them. It's good enough for me. Now you're in tough shape. And it can be tough enough. I've seen many VCs, I've seen many investors walk away from deals because there's just too much convertible ahead of them. Why do they care? It's not coming out of their hide, right? They're the last money in, they're going to make a pancake out of it and determine what percentage they get. It comes out of the founder's shares. Why does the VC care? Because they need enough common stock to incentivize the founders. And if there's not enough if there's not enough stock in the deal for the founders because the safes took it all, it's kind of like next. They'll go on to the next company. So be super careful about that. Model it out. Here's some modeling for you. We don't have time, but make sure you do your what ifs with the typical cap table. Here's a typical cap table. I like to plan into it. Say this is where we'd like to end up after round A. Some other diligence issues. Make sure if you're my neighborhood, we do mostly tech startups. We deal with IP rights. You want to make sure you have secured all your IP ownership, a lot of legal due diligence. Mistakes are free or almost free before you get a term sheet. After that, they're going to cost you valuation points. Get the stuff nailed down early on. Employment claims, I do a whole thing around how much trouble you can get into getting the wage and hour and classification law wrong. Lots of other stuff that look at my Startup Basics seminar if you want to deal into them. Getting back to the VC side of this, how much money should you take, right? How much money should you take? Here's a rule of thumb. You take enough to get to the next valuation event, right? You don't take any more than you need, and you always need more than you think you need. Plan it out, map it out, do your pro forma financials. You take enough to get to the next valuation event. You're going to hope the next valuation is going to be within 1 or 2 years, and it's going to be 2 times the first valuation. You may not get there, but you're going to hope for that. And you're not going to turn the money away if it's not. And you're not going to insist on it if you think that number is too high, because then when you do the follow-on round, the last thing in the world you want to do is a down round. That is a very bad thing. Tune in on June 9, I'm going to tell you how we're going to deal with down rounds, but you'd rather not have to have the problem. So you shoot for the sun, maybe you hit the moon 1 or 2 years, 2 times, but definitely only enough to get to the next valuation. Why? Because you're taking that money at a low valuation. You're giving away a lot of the pie at that point. Pitch deck, there's plenty of people out there that'll teach you how to put together a good pitch deck. Please do not have a 90-minute presentation. I've been stuck in those before. By the time it's over, you're so mad you had to sit through 90 minutes. You don't want to even look at the founders anymore. Did not mention valuation in your pitch deck. Okay, don't do that. Whatever number you put out there, the professional investor is going to cut that in half. So don't even start. Let them give you a number. Here's a good template. I like to start with an executive summary, just the facts, right? Just the facts. So you can get in front of your investor. You can say in a glance whether you're a good fit for them or not. All right. What's your mission? What's your business? What's your industry? What's your IP protection? How big's your market? What's your pro formas? That sort of thing. And most importantly, who's your team? Why are they awesome? But do it with a 1-page, maybe 2-page executive summary. Otherwise, you might never get to the pitch deck stage. All right, we're a little further than halfway through my slides. I wanted to do term sheets with you. I'll tell you what, we'll do this again. We'll have a follow-on webinar. We'll spend an hour going through term sheets and all the things to negotiate once you get to the VC table. But for now, we're at 8 o'clock. We're at the top of the hour. And my friends, I'm going to open this up to questions. All righty, we have a lot of questions. Let's just take a look at these. Well, I see Pamela Fuller has a question about carried interest. She has an answer. Remember, I said, why do they call it carried interest? Pamela says it's because the partner is being carried by the other investors because the VC is getting a profits interest that's not proportionate to its actual equity interest. By the way, Your VC structurally will act as a general partner of a limited partnership or a manager of an LLC. They're no longer, they're in the old days when Pamela Fuller and I started practicing, the law required them to put a little money in order for that entity to be treated as a tax partnership. It's not true anymore. You don't have to do that anymore. But still, it's a fossil, just like 4-year vesting, that the GP will put some of their own money in, like maybe 1%. So they can have a lot of their own money in a company. Part of it's just historical, kind of the reasons they use limited partnerships. It's mostly historical, and it just sticks around. The other reasons that shows the investor they've got skin in the game. Anyway, Pamela thinks it's a carried interest because the VCs are carrying them. I've heard it said it's a carried interest because it's a term from the old shipping days when shippers would get paid freight for cargo based on how much they carried. Or another way of looking at it, they get paid for what they carried off the ship. so that's one theory, but I like Pamela's better. Okay, now to a serious question. Let's go back. Somebody wants to become an angel investor. What's the best way to become an angel investor? Assume I've run a company before. Well, I got news for you. It's the easiest thing in the world. It's like falling off a log. I mean, just come to one of Rob Lau's pitch events. You'll find 1 million people looking for angel investors. Angel investors don't advertise, because people love angels. It's viewed as a little bit easier money. It doesn't have the due diligence attached to it. Doesn't have the management rights attached to it that venture does. The easiest way is just to come to our pitch events and look for cool companies. Easy to become an angel investor. Very difficult to become a successful one. Okay. I think I heard Dave McClure say one time that if you invest in one company, you're going to lose your money. If you invest in 2 companies, you're going to lose your money. You got to invest in 10 companies because it's a numbers game, and they all have to be sure things. I do some angel investing. I only invest in sure things. It hardly ever pays off. In fact, the last 2 investments I made in Q1 of 2020, you're going to love this. One was in a nightclub, the other was in a restaurant. So don't ask me what to invest in. I'm a terrible stock picker. Is it the best time to get money from angels without traction, with just a prototype ready? And what's the maximum you can get? Well, it's an interesting thing. There was a time when angels didn't have to see traction. You could just wow them with your beautiful design and your slick looking PowerPoints. Not true in my neighborhood. Even angels want to see traction now. You might sell them on a wing and a prayer and a promise. You might have good track record. Maybe this is the third, time you've hit home runs. But for the most part, angels are looking for traction, just like institutional investors are. So I'm not sure it is a good time to get money without traction, especially now. I think you're going to have, if it's truly angels you're after, you're going to have to show them that you can sell your product. People are going to buy it. Okay, existing VC wants to get out from the investment. Can we raise the fund from another investor and pay the old investor to get out of the investment? Yeah, so that's the problem. No, you can't. You're married to them. You're married. They're in that investment as long as they want to be in that investment. You can only do that if they're willing to get bought out. Now, sometimes, by the way, I seem to see this more than other people. The VC will negotiate a prenup, and they'll have a redemption right built into the documents so that they can get out. They can force you to buy them out if they don't like you. Of course, you don't have the money, but they have that right. I think we're going to see that a lot more. Tune in on June 6th. I'll tell you why. But for the most part, no, you're stuck with them. Unless they want to leave, you're not buying them out. Trust me, they can put up with a lot more, obnoxiousness than you probably can. That's their business. So be careful who you pick as your partner. What's the difference between a board seat and a board observer? Good question. A board seat and a board observer. Can an observer vote to boot the CEO for not performing to expectations like a board seat? No, a board observer has no power. They have no voting rights. They can sit in the board meeting and be disruptive and make their views known. But they're not fiduciaries. They don't vote. They don't make decisions. They don't bind a company. They're just there to represent the interest of their investor. Now, here's why you have board observers. Series A board will usually be about three board members. Not always. Sometimes you'll get 5, but let's say 3 board members. The founder is a board member. I want to talk about this actually. Founder is a board member or someone that the common selects. And the founder is going to say, the common all love me. They're going to select me. The lead preferred investor has a board seat because money talks, right? And they negotiate it for that. Well, now you don't want an even membered board because the board's going to get deadlocked, right? So you need at least a third board member. Well, who's that going to be? Usually it's some independent, industry luminary, somebody we all agree on, that's going to be in there. It's going to represent, the fair compromise. Sometimes, other times it's somebody else selected by the common. How much negotiating power do you have? But a typical board, founder-friendly board would have somebody that the common selects. More typical board's going to have an independent. So it's going to take 2 of those 3 to boot the CEO and fire the founder or whatever the game is. And by the way, founders, don't get too attached to your company if you're taking venture money, because the VC is investing in your company because they want to turn you into something different, something much bigger. And usually the skills that got you to the VC's door are not the same skills you need to get to an IPO or an exit. So it's a real concern. I mean, am I going to get kicked out of my own company? And I see that happen almost every time. Eventually, for a successful company, not almost every time, but often. All right. So the observer. So now we've only got these 3 seats, but the VC, he brought all his golfing buddies along into this deal with him. Not me, of course. They only let me invest in bars and restaurants during a pandemic. But they bought the other VCs into it, and we don't have any more board seats. We don't want a 9-member board. We'll just never get a quorum. We'll never get any action taken because we can't get everyone in the same room or on the same Zoom. So it's 3. How do we give these people the right to have a say, to weigh in? We give them an observer role, so they have a right to sit in on board meetings, right? They have a right to weigh in. They just don't have a right to vote. You see that very often. In fact, I've been in boards, venture-backed companies. I'm not kidding. Biggest names in Silicon Valley are sitting there as an observer. And they're saying, holy cow, they won't even let this guy vote, but they need him there because he's an observer. He knows the industry. He knows how to make people rich. That's an observer. By the way, the other thing is advisors. I talked about advisors. They're nothing like observers. They're nothing like board members. They have no authority to vote, or they don't have meetings of advisors. They're there to advise on a very specific topic. So when you hear somebody talk about a board of advisors, it's way different than a board of directors. Not even close. So don't get them confused. Sometimes people do. What's a huge market? Having a large percentage of a small market might be better than having a small percentage of a large market. Yes, and we've all seen those pitch decks. They all say, look, if we just get 1% of this market, we'll all be billionaires. That may be true, and that may be a good pitch. That may be a good sale. You might say we're just so disruptive and so new, we're going to take most of this market. I'm not so concerned about that as I am about how big is that company going to be? How big can that exit be? Remember the example. Suppose you're the VC and you've had 9 companies break even. That 10th one, it better be a home run. It better be huge, right? How big is a big market? Well, if your biggest, exit's going to be at $100 million, that's not good enough for a VC. It's just not. It's got to be a much bigger exit than that to get, to get the VC. Now, smaller funds, of course. And by the way, we got this thing called super angels now and angel funds. They look a lot like VCs, but they're willing to take a little less risk and a little less return. For an angel, a $50 million exit can be a very good exit. A $100 million exit's great, for an angel or an angel fund. But you're talking VCs, they're looking for big, big numbers. All right, my economics slides to 7 to 10 year terms. Are there any shorter terms on deal sheets? Is the management fee negotiable? Let me back up a little. So what I was talking about VC economics. I was trying to give you a sense of what the constraints are on the investor. What are they working against? When they're looking at you, they're doing math in their head. What are they thinking about? They're thinking, how much do I got to make on this company? All right, to do that, they're thinking of their investors that they have to satisfy. Now, before they make anything, they got to return capital to their investors, right? And then they're going to make a carry of 20%. So their investors are taking 80% of the gain, and they got to make 2-3 times their money. You do all the math, and you'll come up with, why why they have to make a lot of money on your fund, why they got to make 10 times sometimes. So when I say 7 to 10 years, what I mean is that's the length of the fund. So let's say that this is not going to happen because VCs spend the money early and then do the follow-on rounds later in the fund. But somebody comes to you, they got 3 years left in their fund life, right? They make an investment in you. They're going to expect you to exit at a pretty high multiple in a very short period of time. Now that doesn't happen because, it does happen. I have seen funds make investments late in life if it's too good to pass up, but it's going to have to be that way. It's going to have to be something that's going to exit at a big return fairly late in life. Is the 2% management fee negotiable? Yeah, that's just the standard. But again, that's how much the VC is charging their investors, just to cover their overhead. 2% and what do I mean by committed capital? Is 2% of the money that the investors promise to put into the fund. So usually when a fund gets put together, the investors will promise to put a certain amount of money into it, right? They won't put it all in all at once for a lot of reasons. One of which is it hurts the internal rate of return that the VC gets to tell the world about that he got. So he wants, just money as they need it. They don't need a lot of idle funds sitting around, getting interest at 1 or 2%. So they'll put in a big chunk now, and they'll promise to put it in over the next several years. The 2% is based on the promised amount that's coming in. And like I say, there's some parameters. Sometimes I see it start at 2.5 and then go down, and then it quits after a period of time when the VC's done managing and all they're doing is sitting there as passive investors. Yeah, then it quits. But don't get hung up on that. That's a venture capitalist term. Not something you need to worry too much about. Hi, Alan. How much time do founders need to spend on fundraising when a startup gets to that stage? Give me a second. Way more time than you think. Way more time than you believe. It's going to be so distracting, and you're going to hate doing it, and you're going to want to take more money than you should just so you don't have to go out and do it again and spend all that time sitting in those meetings, traveling, putting your pitch decks together, doing the research. I can't give you a number. All I can tell you is everybody complains about it. How do you decide your salary as a founder? Salary as a founder? Are you kidding me? So here's the thing. California law is going to require you to take a salary. We have minimum wage laws here, but minimum wage is not very much. And to be exempt, it'll have to be 2 times minimum wage, but still, it's not a lot. Nevertheless, most founders won't take a salary until you get funded. After you get funded, then you are going to draw a salary, but that salary is going to be market, and it's going to be, but market for a venture capitalist funded company is way less than market for what you get, going across the street and working for corporate America, because you got a big chunk of equity, and that equity is your compensation. You're getting a salary so you don't starve to death and you can put gas in your car. But the big bang is going to be the equity, and the founder and the VC. By the way, the VC needs you to have that equity. They need you committed to the company. That's why ICOs really never took off in the venture capital community. There's too much liquidity. Your founder gets a bunch of tokens instead of stock. They can exit. They can leave the company and leave you, the investor, just hanging there. So they're going to keep the salaries low and the equity high to keep you invested. And that's why I say you sell too many safes, you might not have enough of that equity in order to attract the VCs. That means we got 15 minutes left. All right, does the valuation cap or discount apply as opposed to being applied both, given the valuation exceeded the valuation cap? I think I know what you mean. So yeah, it's one or the other in effect. You're not going to get a discount off the valuation cap, if that's what you're saying. Tell the angel to call me. The angel will call Pamela. How to find a trusted advisor? What should we look for? Here I am. Good question. I want to pause on this seriously for a minute. Be careful about finders. I'm not saying don't use finders. I'm just saying be careful about finders. This valley used to be full of them. Back in the early 90s, there was a finder everywhere. And you had to be careful because sometimes a finder goes to, see, it's different. Private equity, very common to have investment bankers and people raising money for a fee. In venture capital, we all know who the VCs are. You don't need somebody to open that door for a fee. If you do, you send a message to the VC that you're paying somebody to find money. Be careful about that. Now, on the other hand, having said that, there's nothing better than a warm introduction. The very best introduction to a VC you can have is by the CEO of a company that VC has funded. So if you really want to meet, XYC VC, buddy up to the CEO of one of their portfolio companies. That's the best thing you can do, because that's somebody putting their reputation on the line, vouching for them, telling them they know everybody. Second best is probably to have a lawyer make the introduction, because we don't get paid a fee for doing that. We just do it because we want to see you guys become successful. And I don't introduce dogs to VCs. It's going to hurt my reputation, so I'm putting my reputation on the line as well. But a warm introduction is really helpful. In terms of trusted advisors, get a financial person on board. I see companies, they don't respect the financial function enough. Don't respect the part-time CFO function. That's the first thing the investor is going to do, is they're going to have financial people come in. It's super important that you have really good numbers and you can have some projections, know where you are and where you're going. By the way, don't put the financial person in before the technology person. You need to have a product, before you can have a financial person. What's my perspective of funding dynamics due to COVID-19? Your perspective, I'll give you something better than my perspective. I'll give you a VC's perspective, because I've been listening to them on webinars almost every day. Number one, valuations are going to go down. They just are. Everybody said that. In fact, that's why there's a pause in the market. It's not because VCs are frightened and they're going to go back and give their money back to their LPs, because they're just going to wait until the valuations can go down. And then they get more stock for less money. So I think that's number one. Number two, and I've seen this with my clients, companies that had trouble raising money 6 months ago are going to be hot, right? And you can guess who they are, right? You can guess what industries are winning right now, right? And you can guess that telehealth is a good place to be right now. And you can hear VCs talk about it. So I think the funding dynamics is going to shift to the company. And by the way, consumer is going to be a lot bigger now. I heard that this morning from a VC on a webinar. I think consumer is going to change a lot, and different types of consumer companies are going to do well. The ones that are reacting to what's going on in the world, and what we'll probably have a repeat of in the fall. Okay, is it true that IPO is not a VC interest? No, I wouldn't say that. I mean, I think it's very interesting. They're just so hard to come by anymore. Don't get me started. Remember Enron, remember, what is it, WorldCom, remember Dodd-Frank, remember SOX, remember all the rules that made it really hard for companies to go public. I think you'd have to be crazy to want to be a director of a public company these days. And plus the market's changed too. It's just not, I wouldn't say it's not of interest. I just think people have to expect that M&A is a big candidate. What's a good amount of compensation for a board observer advisor? Let's talk about advisors. Advisors, remember, between 0.1 and 2%. Typical advisor, 0.25% to 1%. That's where I start. Take a look at the FAST agreement put out by the Founders Institute if you want to see a really good matrix as to how you might come up with an objective determination. But it depends on the stage of the company and how involved and active your advisor is in the company. But again, 0.25% where I start. If they're, if they're really good, you'll go up to 1%. You really need them. I'm actually, it kills me to do this, but I'm working on a deal recently where the advisor took 4 or 5% because they were such a big celebrity name in that industry. that just having our name attached to the company was almost guaranteed to make it successful. We had to do it. But otherwise, you're going to start at 0.25%, negotiate from there. You're going to give stock or options, never cash. Observers is kind of all over the place. If they get anything at all, usually they're associated with the investor, so they're getting rewarded through the through the investor shares, not through any separate compensation. Yes, my slides are available along with the recording, or if you want them, you'll find them on my SlideShare account, or you can just email me at haynesboone.com and I'll make sure you get a copy. I heard venture builders take more equity at early stage. More equity. Okay, so here's how I look at it. I mean, rules of thumb are kind of risky, but it's going to depend on the investor. But just think of 10% to 40%. I think of just rule of thumb. I think you're going to give away a third first round, but realistically 20 to 40. And the way the investor's looking at it, again, this is getting inside their head and thinking of their economics. They're gonna have two variables and a plug number. Variable one, by the way, this is the second part of my presentation I didn't get to, is a big part of valuation. One way is, how much money do you need to get to that next valuation event and double your value, hopefully, within a year or two? And how much equities does the VC want to have in your company? Poof, there's your valuation, all right? And I think different VCs take different approaches to that as to what kind of stake they need to have. But trust me, they're strategizing. They're thinking way ahead. You should too, so you don't have people with different expectations. Where do I find VCs interested in water-related technologies? Thank you. Come and take a look at my AgTech site. Google Silicon Valley AgTech or Royce AgTech Innovation Network. We have lots of water companies and lots of VCs looking at water for irrigation and agriculture, but also a new thing, not so new, but a thing called AridTech. AridTech, water from Israel and the Middle East, or tech for Israel and the Middle East and the deserts of California. We see lots of technologies around that. I know investors, I know funds that are focused just on that, believe it or not. By the way, there are a lot of funds that are very specific, and we didn't get into that. In fact, I'm going to have to amend my slide, so we talk about that. Very specific about what they invest in. Agriculture technology funds, right? Believe it or not, water funds, a lot of health tech funds, stuff like that. Clean energy funds, even now. So they're out there, and they're not hiding, all right? My new email, yes, that email is valid. My new email address is roger.royce with an S, roger.royce at haynesboone.com. Thank you. Okay, now somebody against my advice sent me questions on chat, but we've got some time, so let's take a look at it. All right, let's go through the chat questions. Can you see the panelists in the waiting room? Why, yes, I can. Thank you. Okay. Okay, it's the share profits of an investment paid to the manager over the amount that the manager contributes. Again, I don't need you to get too bogged down in this. What I'm trying to illustrate is that, and I've heard VCs sit in my conference room and tell me, geez, I got to make 30% before I even get anything, before my investors even get anything, because they're paying me a carry. I got to have big returns. All I'm saying is that this is expensive money for you, but there's a reason. There's got to be big returns, not to the VC so much, way back to the ultimate limited partner. So their share of profit's going to be, yes, over the investment that they return. Here we have a company that's a California C Corporation. That's a good start. Registered in Delaware. We got to start over with a new one. So this is the bigger question. A lot of times companies, so to be a VC candidate, you're going to be a Delaware C Corporation. To be a lifestyle business that makes you a good living and throws off enough money for you to, order Uber Eats every night. I was going to say go out to dinner every night, but we don't do that anymore. That's a way different kind of company. That's going to be an S Corp or an LLC, right? That's a lifestyle company. It pays you an income. It's never going to have a big, huge, explosive growth. What if you're in the middle? What if you're a company that can make a little bit of money now, but can be profitable, can do very well, but if you get some money, you can scale this thing and become a huge success in a huge market. You're in the middle. So here you are, you're a pass-through, you're an LLC, you're a California corporation, you're something that's not quite what a VC wants. Very simple, very easy to convert that into a Delaware C Corp. Just trust me. It's a little trickier with an LLC, I want to admit. There are some tax considerations you need to think about. There's a few gotchas. There's some stuff that's counterintuitive that you wouldn't think about, but I've done it 100 times. It can be done. We do it frequently. Just do it, just know what you're getting into. It's irrevocable as a practical matter. I've got some ways out of it, but think of it as irrevocable. And think of it as something that's going to affect that qualified small business stock exemption that we were talking about. That's usually one of the prime drivers. So, you don't have to start over with a new corporation, not for that reason. You might have to, you can easily convert it. You might have to start over for other reasons. If you've got baggage, if you got diligence problems, you got a goofy governance structure, you've got a funny buy-sell, stuff like that. You've got litigation, whatever it is, but not for that reason. Someone would like to hear my views of investment in fintech. Well, I'm a big believer. It's one of the big three verticals that I practice in. First is agriculture tech, second is health tech, and third is fintech. And I got into it in a big way because of blockchain technology and crypto. The SEC and other U.S. regulatory agencies have been quite a disappointment to me in that regard, because I think it could have been a much bigger thing in this country than it has been. But I'm not done with fintech. I think there's lots of opportunities, and I think that's one of those industries that could do well because of COVID, because people have to get used to a new normal of doing business differently, and part of that means financial services, security, and fintech. And I also think that there's still a lot of room for improvement. And I do know investors who like fintech. Now that is a broad category, of course. God, there's so many ways that when you say fintech, that could mean so many different things. But I'm thinking of one area I think is hot is, and I'm not the VC here, but I hear other VCs, and I like really good consumer apps for fintech. That seems to be a growing area. It's the millennials, driving the market again. I think the developing world, there's a lot of opportunity to put in place electronic financial solutions in places that don't have the old brick and mortar infrastructure. So yeah, fintech is still hot. It's not like clean tech 10 years ago. It's a dirty word. It's still okay, even though no one likes to talk about crypto anymore. But your topic is specific to digital banking. Yeah, I think all that stuff is going to be very hot. Okay, holy cow, I got a bunch more questions here. Let me go back to the Q&A. Are enterprise startups in low demand from an investment standpoint? I don't think they ever will be. We did a panel on that with Idea to IPO just about a month ago, and we had one VC who thought, who still is very bullish on enterprise. So enterprise as opposed to consumer, I think is what you mean. And no, I don't think they're in low demand at all. I know investors, institutional investors, who are very much interested in that space. So you're asking me what's hot and what's not, and your guess is as good as mine. Just read the papers and kind of figure it out. But some of this is sort of intuitive, I think. Just look around. If you're, if you're doing, like I say, obviously telehealth, right? Obviously anything in telecommunications. I think anything in security is going to be hot. But if I had the answers to those sorts of questions, I would be a client and not a lawyer. I would be the VC instead of the advisor to the VCs. Okay, at that, believe it or not, we are at 8:30. I have answered all your questions, or at least I think I have, especially except the one about how many panelists are there. And I just want to remind everybody that I only got halfway through my slides. I'm going to ask Rob if we can come back and do this again, and I'll just drill down into actual terms and actual negotiation and actual legal terms. And then we are coming back on June 9 at noon, and we're going to talk about troubled company strategies, especially when you're being approached by the venture community or they're already invested in you. I've seen this movie before. I was around in 2008 when it happened last time. I know how this is going to play out. We're going to talk about what's going to happen, what you can do as a founder to protect yourself from creditors, predators, and investors. So we're at 8:30. Thank you very much. And the recording's available, and we will see you on June 9.